What if I told you that the world could be only 2 years away from the kind of inflation that destroys currencies, evaporates savings, and forces governments to rewrite the rules of money itself? Hyperinflation isn't just a weird anomaly from bankrupt nations in history books. According to many economists, the conditions that created those disasters are starting to reappear globally. And if the trend continues, 2026 might be the moment when the fuse finally reaches the dynamite. Today, we're breaking down why some analysts believe hyperinflation could be closer than anyone wants to admit, what signs to watch for, and how the world could change if it hits. Let's get into it. 1. The silent setup. Global debt and monetary expansion. To understand why hyperinflation could hit by 2026, we must begin with a principle that has held true throughout economic history. Money printing eventually has consequences. Not always immediately, sometimes not for decades. But eventually, market confidence cracks. 1.1 The explosion of global debt. Since 2020, global debt has risen faster than at any other time in modern history. But what makes the current situation especially dangerous is the combination of high debt and rising interest rates. Governments around the world borrowed heavily during the pandemic. Instead of slowing down, many continued to expand spending even after economies reopened. By the mid-2020s, major countries were carrying the highest debt-to-GDP ratios since World War II. Here's the critical point. High debt plus high rates equals unpayable obligations. Historically, nations in this situation choose one of three paths: default, politically unacceptable austerity, politically suicidal, inflate the debt away, quiet, invisible, and very tempting. The third option, inflating the debt away, is the soft name for what eventually becomes runaway inflation if overused. 1 point to the pandemic legacy. Too much money. Too fast. Between 2020 and 2022, the US, EU, Japan, and many other economies increased their money supplies by 20 to 40% in record time. In the US, more than a third of all dollars in existence were created within a 2-year window. For a while, this didn't cause hyperinflation because supply chains snapped, people saved stimulus checks, spending slowed due to lockdowns. But as soon as economies reopened, demand came roaring back while supply stayed wounded. And the inflation spike of 2021 to 2023 was born. This was not hyperinflation. It was a warning shot. And it revealed something dangerous. Central banks are willing to print huge amounts of money if they feel forced to. That is the exact mindset that typically leads to currency crises in history. 1.3 The return of temporary inflation. By 2024 to 2025, inflation had cooled from its peaks. But underneath the surface, structural inflation remained elevated. Rent stayed high, food prices never went back down, energy costs kept creeping upward, wages increased permanently. Analysts call this sticky inflation, the type that rarely reverses without recession. And governments now fear recession more than inflation. This is the perfect setup for the next act. 2. The triggers. What could push inflation into hyperinflation territory? Even with rising prices, hyperinflation doesn't simply appear out of nowhere. It requires trigger events, shocks that overwhelm the system and push governments into extreme monetary responses. Experts warn of 3 possible triggers between now and 2026. To point 1. Trigger 1. A sovereign debt crisis. When interest payments on debt exceed tax revenue, the government faces a math problem with 3 outcomes: cut spending, raise taxes, or print money. Cutting spending risks riots. See France, UK, much of Europe. Raising taxes risks recession. Printing money seems like the least painful option. If a major nation, the US, Italy, Japan, or the UK, hits a point where interest payments become unmanageable, central banks may step in to stabilize the situation. That stabilization often means creating money electronically to buy government bonds. If this escalates, inflation surges. If investors lose faith in the currency, hyperinflation becomes possible. To point to trigger 2, a major geopolitical shock war is the oldest hyperinflation trigger in the book. Germany, 1923 Hungary, 1946 Yugoslavia, 1994 Zimbabwe, and Venezuela. In the 2000s, whenever a government faces enormous unexpected costs and revenue collapses simultaneously, money printing becomes the emergency exit. Between 2024 and 2026, global tensions have been rising. Conflicts in Eastern Europe, unstable regions in the Middle East, China-Taiwan tensions, energy supply chain fragmentation, cyber attack frequency. A major conflict or crisis could fracture global supply chains again. But this time, central banks wouldn't have the same ability to contain the inflation that follows. To point 3, trigger 3, a banking system failure. Banks today are extremely leveraged and deeply tied to government debt. If interest rates stay high or rise further, the value of that debt falls, putting pressure on bank balance sheets. We saw hints of this in 2023 with regional US banks, but if a larger bank, or a cluster of banks, fails, central banks will be forced to inject liquidity. This can mean trillions of dollars in a fragile environment that could be the match that lights the hyperinflation fire. 3. The mechanics of hyperinflation. How it actually happens. Many people imagine hyperinflation as prices suddenly skyrocketing overnight. But that's not how it begins. It's a psychological phenomenon, not just an economic one. 3.1 Stage 1. Inflation feels normal, but gets worse every year. This is where many developed countries currently sit. Groceries cost more, housing is unaffordable, insurance is rising double digits, energy prices are volatile, people complain, but life goes on. Yet underneath, purchasing power erodes, slowly at first. 3. To Stage 2. Governments lose fiscal control. This is the danger point analysts worrying about for 2025 to 2026. Governments begin spending more just to maintain basic services and interest payments. They roll debt forward at higher interest rates. Deficits expand. Investors start demanding higher yields to compensate for risk. This increases government borrowing costs even more. A vicious cycle forms. 3.3 Stage 3. The public loses confidence. Hyperinflation begins not when the money supply increases, but when people believe it will continue to increase. They start spending money as fast as they receive it, before prices rise again. This velocity surge is catastrophic. Imagine workers demanding weekly or even daily pay, stores raising prices constantly, savings evaporating, people rushing to convert money into goods, crypto, gold, or foreign currency. This is the tipping point. 3.4 Stage 4. The currency collapses. Once confidence is gone, it's nearly impossible to restore. Governments respond with emergency measures, price controls, rationing, freezes on bank withdrawals, capital controls, new versions of the currency, digital monitoring of money movement. But none of these restore trust if the root problem, uncontrolled money creation, persists. Hyperinflation is ultimately a loss of faith, and confidence breaks fast. 4. What hyperinflation by 2026 would look like, and how people can prepare. If hyperinflation were to hit by 2026, it wouldn't look like Hollywood movies. It wouldn't be complete societal collapse. Instead, it would be a dramatic, painful, but historically recognizable economic breakdown. Here's what that world might look like. 4.1 Daily life changes quickly. Food prices change every week. Rent climbs rapidly. Savings accounts become worthless. People rush into physical goods. Credit becomes harder to get. Long-term loans vanish in extreme cases. People line up to buy essentials before prices rise again. Cash becomes a hot potato. 4.2 The middle class takes the biggest hit. Hyperinflation destroys savings, pensions, fixed wages, insurance, long-term contracts. The wealthy, who hold assets like real estate or equities, are insulated. The poor rely more on government subsidies. The middle class gets squeezed out. 4.3 currencies are replaced or reset. Almost every hyperinflation event ends in one of the following: a total currency reset, new notes, new rules, dollarization, the country adopts a more stable foreign currency, hard asset backing gold, oil, commodities, a forced central bank digital currency, CBDC, capital controls and monitored money movement. The modern world is more likely to adopt digital replacements. If hyperinflation hits by 2026, government-issued digital money could become the reset button. 4.4. What an individual can do today. This portion gives viewers practical steps, the kind most people wish they'd taken before previous inflation crises. A. Diversify your assets. Don't keep everything in one currency or one form. B. Avoid too much fixed income exposure. Bonds get crushed during inflation. C. Consider hard assets. Historically inflation-resistant assets include commodities, farming, resources, metals, real estate in stable regions. D. Strengthen personal income skills that produce income in any currency. Provide resilience. E. Build an emergency buffer. Scarcity becomes common in hyperinflation environments. F. Think globally. Sometimes the best protection is having financial exposure outside your home nation. These aren't predictions, they're historically proven strategies. Conclusion: could hyperinflation really hit by 2026? Hyperinflation is rare, but economic crises always look impossible until they happen. The world in the early 2020s experienced once-in-a-century shocks, pandemics, war, supply chain fragmentation, unprecedented money printing, and rising geopolitical tensions. The next few years will determine whether governments regain control, or whether the inflation we've already seen was only the beginning. Whether hyperinflation hits by 2026 or not, the warning signs are flashing. Understanding them isn't fear-mongering, it's responsible. Because financial storms don't punish the prepared, only the unaware.